way above the Fed's target of 2%. So the big question is if the US Central Bank is going to keep raising interest rates or at their high rate for the rest of this year, or might they actually need to be even more aggressive than we already expect them to be? Well, we're joined now by Dryden Pence, who is the Chief Investment Officer at Pence Capital Management. Thank you very much for being with us today, Mr. Pence. So let's talk about that inflation figure for January. Does it suggest that inflation is falling in the way that we'd expected or indeed had hoped it would be?
Well, good morning. Well, good afternoon. Thank you for having me on. And the point is, inflation directionally is moving the way the Fed wants, but the magnitude is slowed down. And part of it is lag effects in the U.S. economy. We've yet to really see the last 150 basis points of Fed raises work their way through. It takes 4 to 6 months to really work its way through the economy. And so we think the Fed's probably going to continue raising at a 25 basis point clip, and they're going to have to then switch from how high to how long they hold the pause.
And indeed, one of the things that you've been pointing out is that consumer spending in the US is still holding up, despite all those levers that the Fed is pulling to try and discourage demand within the economy. Why is that, do you think?
Well, nobody told the U.S. consumer, don't fight the Fed. And when you have a tremendous amount of employment, a lot of people have jobs, unemployment's very low, incomes are rising. And the key issue is people have a lot of savings left over from all the COVID stimulus. So when you have American consumers, they buy, they consume all the time. And with the strong balance sheets and a lot of cash in the bank and low unemployment, you still have this large aggregate demand thing working its way through the economy. So they're continuing to do what Americans do. They buy.
Yeah, indeed. And perhaps that's part of the reason why a lot of economy watchers are starting to think that this year won't be as bad as we thought it would be, those expectations towards the end of last year. Are you on board with that wave of thinking?
We're on board with the idea that if there is a recession, it's in the back half of the year, and it's a very mild one. We're probably out of it before we really feel it. So it's either a mild recession or no recession in the back half of the year. And part of this is because the American consumer kind of holds up strongly. And sooner or later, the Fed is going to stop raising and switch their thing from how high to how long. And those adjustments will work their way through the economy. And we're in a very robust situation.
I wonder as well, when you look at the circumstances behind this economic crunch, we got high inflation contributing to a faltering economy, but also a sharp labour shortage. We're not accustomed to circumstances like this. And I wonder if, with that in mind, we should take all economic forecasts with an extra pinch of salt right now.
I think that's exactly right. When you have 2 jobs for every person looking, you really, in the U.S., you could say when you have a recession, you lose maybe 4 million jobs. Well, right now, we could lose 4 million jobs and it not affect us, right? That's 4 million jobs we can't fill anyway. So I think that's one of the things. It's a different environment than all the prognosticators have been in for a very long time. So this time it is a little bit different.
Okay. Dryden Pence of Pence Capital Management, thank you very much for joining us with your thoughts.